All right, and now we shall proceed to our next segment. Our next speaker is a veteran economist. He currently serves as a resident bank economist of the Philippine National Bank. He was formerly a senior economist of Citibank with the rank of director, covering the Philippines and Thailand from 2000 to 2017, specializing in macro analytics with emphasis on financial market implications and forecasts. He also regularly cited as among the top economists or fixed income strategists in the local asset markets by the Fund Manager Association of the Philippines and other regional surveys like The Banker and Asia Money. To impart with us why he thinks the Philippine economy is too robust to ignore, let's all welcome on stage Mr. June Trinidad.
Magandang umaga po sa inyong lahat. Thank you so much. As I speak and stand here before you, I know we are besieged by negative news flow coming from that recent the natural disaster. So very close to us and affecting some of our brethren. And not to mention regulatory risk issues and very recently, this invasion of a potentially threatening virus known as the coronavirus coming from China. That certainly has everyone worried. Well, my role is not to address the gravity of the situation right now, perhaps linked to each particular risk that we see, but perhaps to remind everyone that despite all this, the macro upside is still quite robust. And why am I saying this? Mainly because there are strong spending catalysts. Catalysts that are investment-linked, investment-related, probably going to be led by, as you well know, fiscal stimulus, more infra spending, considering that the budget right now for 2020 has not been restrained by Congress, while at the same time, last year's budget that continues to be half spent will probably be felt in 2020. And not to mention, as I'll highlight later on, there are numbers that tell us that PPP, ongoing projects, and new ones are likely to be started. And more importantly, buried amid all this very negative news is the very strong investment approvals that the Board of Investments reported to be a record high of 1.14 trillion pesos, concentrated in a few key sectors that address some of the structural weaknesses of this economy. So when you put them all together, yeah, it looks good, right? Sounds good. And perhaps on this basis, let me highlight a couple of things. One, when we see in any economy here, China, Thailand, in the US, in Europe, when you see very strong investment activity, one thing that should be very clear in our minds, in the near term to medium term, it provides us with that hope, with that faith, that domestic spending, domestic demand will be leading the way. Leading the way. And perhaps stay resilient for as long as people are investing. Big companies that April and Wanis would be talking to you about later on would be benefiting and perhaps initiating much of this investment activity moving forward regardless of regulatory risk. And the other implication why it's a bit exciting to look at it from the macro perspective is that it doesn't end with new buildings coming up or bridges, linking this and that, and you take it and say, so this is where my taxes went to and looks good. Or cutting your travel time to Baguio because now the exit entry points are a lot closer to where you want to go up north. It's not just that. Putting in this new infrastructure, new capex, new production line, But it's what I refer to as that virtuous cycle in which investments create jobs and new paychecks that feed consumption. And hopefully later on, if we see this virtuous cycle materialize and reinforce much of this robust macro picture, much of the consumption will not be your going to Starbucks or just going to eating 3 squares a day, coupled with a lot more meriendas with friends and family. But it's going to be led by discretionary expenditures beyond the basics, which makes even consumption and over the medium term, the lifestyle of the average citizen a little bit more pleasant than before. Now, having said all this, before you accuse me of being in government's payroll, let me say that there are also downside risks. One downside risk in any favorable investment or upbeat environment, for us especially, is implementation. Ang Pinoy po, magaling sa plano. Yeah? Planning and even funding. Pero when it comes to implementation, needless to say, regardless of who's in charge, we suck big time. Yeah? So that's why I'm telling friends that the problem with us is not finishing, because eventually it gets finished, but perhaps not in a timetable that has been promised to us. But it's starting the project, initiating it, getting it initiated here, now, assuming you did all the studies and the funding is available. Yung pong Cebu Mactan Airport, kung nakapunta na po kayo ron, napakagandang edifice, according to friends and expats that I've spoken to, who visited Cebu for business or pleasure. But is anyone talking about how delayed that project is? No, everyone's just happy that it's in there now. And we can talk about all this and more. But clearly, do not be frustrated, but I can tell you, when all these big budgets come in, absorptive capacity becomes an issue, but hopefully, given the experience in the past, this can be mitigated. Second downside risk, the way I see it, when you see strong investment activity that's going to make demand a lot more robust, hopefully for this year, I can tell you inflation is not going to stay very neutral. If you're happy with 2.5% inflation, like what we've seen in 2019, that was associated with GDP growth of what? Less than 6% based on the latest figures. Oil prices moving up and down, but hardly threatening at all. But this time around, the way I see it, if producers, traders see a very firm domestic backdrop, one thing I can tell you, they will pass on some of the cost to the retail market. Good or bad? Well, from the point of view of the companies, that can help improve margins, particularly during the periods in which, last year in particular, when the market was still reeling from weak domestic demand. Because of not just the delayed budget spending, but also because of the train one that probably the effects were still being felt up to the middle of last year. And not to mention a host of other supply issues. So that is a key concern. But one thing I can tell you, rising inflation risk this year is not going to derail much of the demand. Because our economy, these financial markets, can live with inflation of 3 to 4% on average, and still within the upper half of the BSP's target range. It may not necessarily require an interest rate cut or monetary accommodation, but I'm telling you, the cost of money or interest rates is not the problem, not the issue, not the constraint in an upbeat investment environment. And in my view, it's credit and liquidity. Makakautang ba kayo? Kung lahat ng tao rito ay nag-uutangan because they want to buy, to invest in a new home, new business, or scale up the existing businesses at a rate of what? 4, 5, 6%? What you really need and what these Conglos would be sorely in need of would be investment funding. And finally, another key investment risk is that when we invest, you need not just land, right? Or funding, right? But you need machinery, apart from the people to work on all your projects, right? Steel and iron products. Perhaps new equipment, more computers, etc. Philippines doesn't produce all that. So what you'll see in a strong domestic demand would be more imports, purchases of the Philippines from the rest of the world, whether that's in the US, China, wherever we can source the cheap funding as far as our essential imports are concerned. So if that's the case, you will see macro imbalances widen as growth strengthens. And clearly, one key risk that I'm telling you now in this environment is, or the environment that I'm trying to portray, paint before you is, you'll see a weaker peso. If right now it's in the range of 51 or less, be happy. Stock up on dollars if you need to. Not to speculate, not to speculate because that will amount to nothing unless you invest all those dollar purchases into some earning asset. But you buy dollars when it's cheap, and I think the fair market value is higher than 50, 51 because there's a need for you to import for your business, for personal needs. And otherwise, it could also be for servicing dollar-denominated debt obligations. And my number is anywhere from 52 to 53. Is that worrisome? Most of us weren't born yesterday, right? Maybe except Dino. Yeah? And we've seen the highs of the dollar peso, 54, 55, 56. And you survived. Your businesses survived. At 52, 53, it's not a major worry, but bracing yourself for such a situation enables you to save money, and not to buy when the cost is already way up there. So, bottom line is, when you put them all together on balance, when you take into account the good and challenging issues out there from the US trade, of which we are relatively resilient, to the implementation risk, the way I see it, we can still make a go for 6.6% GDP growth compared to 5.9% based on the official statistics. Sorry that this hasn't been, the 2019 hasn't been adjusted yet, but that's my forecast, yeah? And certainly something to look forward to, one of the top growth leaders as far as this part of the world is concerned. And let me just highlight one thing. Dami-daming numero, no? And I don't expect you to take this all home with you, but just one line here. Look at real investments. look at what its contribution, or at least on a standalone basis, how high it's going to grow. 2 digits. And its contribution to growth. When you see this number of 30% of more of investments contributing to GDP, I can tell you one thing. I would take a very strong medium to long-term view as far as that economy is concerned. In China, prior to its present situation, the share of investments to GDP as far as that country is concerned, and other developed markets that we're talking about right now was over 30% of GDP. So sabihin nyo, malapit na tayo sa China. No. That 30% ratio stood the test of time for the next 10, 15, even 20 years. You are seeing a larger contribution of investments to GDP, whether it's on the infra side, new airports, new roads, highlighting connectivity themes, new telcos, new communications, etc., housing, water supply, to private sector involvement. From factories to, more service-oriented industries, taking advantage of improving logistical cost as new investments came in. So, whenever I look at the numbers, this is what I think is very important as far as the Philippines is concerned. Consumer-driven growth, I can tell you, and I'm sure I mentioned it also in this forum, consumer-driven growth preserves jobs. Doesn't create new ones in a very big way. And what we want to see would be these types of catalysts that can create new jobs, incomes, because eventually they strengthen your consumer base that can attract more investments. So you see that virtuous cycle has to start and be reinitiated again following its derailment last year for reasons largely due to political concerns. And here's where I turn a lot more positive. Look at some of the numbers. Once in a while, since we're all taxpayers here, right? Whether you like it or not, go and look at the websites of Go and find out where your taxes are going. On the infrastructure side, here we're seeing that the infrastructure outlays, buildings, budget for GOCCs, these are basically the technical composition of what goes into this larger number of close to 800 billion pesos for under the 2020 budget. And here, I broke it down by region. And needless to say, the framers of the budget last year, coming from Central Luzon, were probably behind much of the larger allocation that that region is going to get. Hopefully, for the right set of infrastructure. But clearly, this should lead the way. And the size here is significant. And not to mention the fact that we have a lot of ongoing construction projects coming from PPP. MRT Line 7 linking Bulacan and Quezon, this is already in an advanced stage. This is still new, LRT 1, and a host of other projects. And when you put them all together, I was amazed that the size is $5 billion. And it's still going on. Yeah? And that is different, may I remind you, the PPP is very different from what you'll see in the infra budget every year. And finally, look at this. Foreign investment approvals, part of the total investment approval picture. But this is just foreign. At least it provides hope for me that as of September 2019, despite regulatory risks, CITIRA and all, we're seeing a lot of investment flows or potential investment flows going into select sectors which I believe not just would have strong domestic demand linkage, but this is exactly where the structural weakness of the economy lies. Information communications, the energy sector, manufacturing. And when I say ICT, it's not just BPOs or POGO-related industries. No. There's over 140 billion pesos of a project that's likely to be undertaken by a foreign private company that will lay out common towers, telco towers, that can be used by the telecom companies all across the archipelago. And for me, that certainly is very good news. Because when you put all this together, and if it materializes 6, 9, 12 months down the road, it's not just going to mean BBB or more construction activity, but certainly it will address some of the structural weaknesses I've said that this economy normally experiences. And this is one indication by regions. Look at this. That 48.3% share, and I'm referring this to the tower rollout for the telco companies. The locations haven't been identified yet, but clearly they're committed to rolling out some of these projects. And by regions as well. Guess who's among those that are benefiting from investment approvals? Calabar Zone. And hopefully, despite the tragedy, the natural disaster that's an overhang on the region, I'm making the assumption here that these commitments will not be indefinitely postponed. They can be delayed because of the potential losses arising from the Taal eruption, but the way I see it, over the short to medium term, it cannot be ruled out. And finally, the investment picture will not be complete if we don't talk about jobs. Based on the latest survey, October 2019, look at the source of job creation. Broken down by different sectors, and here, my pointer is conking out. What we're seeing is that construction has been leading the way, soaking a lot of excess jobs, followed by service-oriented sectors that we have here. And the nice thing there is that for construction, it's across 4 labor surveys. Despite the fact that GDP has not been growing rapidly, what we're seeing here is that all this construction activity isn't, shall we say, depriving us of job creation. And this is what I mean. And look at government. Over 100,000 net new jobs every quarter. Whether it's new policemen, new Metro Manila traffic aides that we see in their crisp, brand new uniforms, medical workers, teachers, government is doing its fair share in addressing some of these vacancies that make public services terribly inefficient. So if we see this, look at total farm employment over the past 4 quarters. Pretty hefty. It certainly will lower the unemployment stock. And hopefully over time, it addresses the problem of not unemployment, but look at that red bar, the underemployment rate that's plaguing much of the impoverished regions. And when we talk about underemployment rate, it's not because they don't have jobs. They have jobs, but it doesn't provide adequate purchasing power for their daily needs. And that is probably the main demand constraint right now. Again, at the macro level, why we're seeing what we're seeing as far as markets outside the urban areas are concerned. And how does all this feedback? One nice thing about all this demand-driven talk is that it's not just your basic expenditures that have picked up. It's the discretionary side. Yeah, and here's a breakdown of basic, indicated by the red line, and the discretionary expenditures, which certainly has deviated to the upside compared to headline. And among the discretionary components, one thing I can tell you is that it's demand for restaurants and hotel services and miscellaneous goods that seem to be benefiting from all this additional purchasing power arising from employment. The latest set of numbers, this component of discretionary demand has risen by 8%. Certainly way above the domestic demand, way above total consumption, and even better than headline GDP. And if you break down discretionary demand, here are the latest set of numbers and components. And we would want to see, the way I see it, if there's any upside that people and companies would look forward to, it would be this segment of consumption. So I've laid out to you a lot of data and highlighting what's important in reading, going through this data analytics. And there could be more. But it all points to, if it materializes, hopefully leading to a virtuous cycle, a very upbeat domestic demand that can make us resilient from what's happening offshore. And one of the risks, it's not all a cotton candy type of environment. The risk would be, you'll see a base case inflation number moving up to the high end of the BSP's target range. And the target range is 2 to 4, and the upper half is obviously 3 to 4. Is that something to worry about? As I've said, we won't be going back to 6.5% or 7% on average. It's way below the recent fearful inflation experience that prompted BSP to hike rates. So the sense I'm getting is that 3 to 4, BSP will be very patient because towards the end of the year, our recent trajectory shows that inflation will head back to the 4% range or less, following uptakes in the third quarter because of the base effects. Yeah? But very consistent with a strong domestic demand outlook. You can't have to always be in the sweet spot of high growth and low inflation, high growth and low inflation for the rest of, our lifetime. At some point in time, inflation is gradually or will catch up in line with fundamentals, and fundamentals now suggest a range of 3 to 4%. question of oil prices because of all this geopolitical risk in MENA, Middle East and North Africa. And we never know where the surprise is going to come from, right? Before it was that drone attack on the Iranian military general, raising threats to Saudi Aramco's facilities and the Strait of Hormuz, where over 20% of the world's oil supply goes through, and much of that going to this part of our world. But while the risk is there, the big question is, meron bang demand? Let's not forget just the supply constraints, but look at it also from the demand side. And one thing I can tell you is that global manufacturing, whether it's because of the US trade-China dispute, China slowing down on its own, global manufacturing is still in a recession. Meaning that over the past couple of months, especially in 2019, this indicator shows it's below 50. What's so special about below 50 or above 50? Based on this diffusion index, anything above 50 is good, expansionary. Anything below 50 is the very opposite. And what we're seeing is that from Eurozone, China has recently recovered, ASEAN, and other economies that have a strong manufacturing content, 25 to 30% of output. Demand for energy from that sector is way down there. And the only thing keeping it up on the supply side would be services. Whether it's Uber, new financial apps that doesn't require a lot more energy, dun lang po ang nagko-contribute sa kanilang GDP, which probably will mean that over time, if this sector doesn't recover, the global backdrop would remain fairly modest to mediocre in terms of pace. And the Fed, central bank, I don't have to highlight, will have to keep interest rates low in those countries. And if that's the case, why would oil prices reach $80 per barrel, $90 per barrel, $100 per barrel? And given the recent experience, what happened? Pumalo po yung WTI Cushing and other indicators, Dubai FATE. And then, after 2-3 sessions, when the fighting, all the noise died down, nag-correct ulit, which tells me that between demand and supply, I would be more concerned on the demand side. And finally, before I leave this, take note that in the recent OPEC, non-OPEC agreement, before all this shooting, geopolitical risk transpired, sometime in July, middle of the third quarter last year, they agreed to what? A 1.7 million barrels per day of cutting oil supply to firm up oil prices. Kung yun, if they did not decide on that, you would be enjoying lower oil prices now. But the point being is that demand has not normalized with all these indicators on the manufacturing side saying that there still is a risk. We're not seeing a major downturn, but the risk is still there. So will be a speak cut in all this. The way I see it, it will be a very, shall we say, it's going to be an overbought argument if they will continue to insist on cutting rates, mainly because inflation is already picking up. Given strong demand and the fiscal stimulus is there, no need for monetary stimulus. Wag po nating abusuhin ang monetary policy. Save it for some time. But what can lower BSP is inflation expectations go back down to 4% or less, which is probably unlikely if we're going to see very strong demand. But if in case it does, what is inflation expectations? It's not the monthly print that the government reports to us at the start of the new month, diba? Soon, lalabas yung January inflation. Sometime first week of Feb. But it's your buying experience. I keep on hearing people telling me, sa palengke ko, ang inflation hindi 3%. Nasa 5% na, 7%. If people were to think that way, different from what was being reported, it certainly is not very conducive to the credibility of policy. But at the same time, it doesn't make sense for the BSP to continue to cut. Only if people were to say, oo, tama yan. Mababa nga. It fits within my budget every month, every week. Hindi lumalang pa sa budget ko. Whether I buy fish, vegetables, pork substitutes. But the way I see it, and the current situation is that inflation expectations are still above 4%, which makes it less compelling for BSP to cut rates further. Unlike in 2016, when inflation expectations fell to a low of close to 2%. And then the other risk of that widening trade imbalance. Already nakikita na po natin dito that the dollar-peso, right-hand chart axis here, is already increased, I think, in the fourth quarter of last year as the trade imbalance, the difference between what we sell to the rest of the world and what we buy from them, has deteriorated close to 14% or more of GDP, prompting the dollar-peso to adjust. But look at what's happening now. Because of the lackluster growth the past couple of quarters and less investment activity, the dollar-peso has appreciated, very much in line with a lower trade deficit. For next year, or this year, sorry, what do I anticipate? With inflation and a larger trade shortfall of 2 to 3% on the current account side, including the remittances, what I'm expecting is this upward bound pattern for the dollar-peso before correcting to 51.50 or thereabouts towards end of the year. So the trade here is, wag na pong mag-atubilig, bumili kung nangailangan kayo ng dollars, foreign exchange, at a time when data and trade and investment activity is not yet pumping up the pressure on the dollar-peso to depreciate. We're looking at 53 and perhaps even higher towards the third quarter when it will be evident, if it will be evident, that investment activity is upon us. More people are buying, companies are buying cranes, equipment to refurbish capacity, augment capacity, steel products, construction materials, cement required for building, and that will be made very clear sometime in the late second quarter of this year to third quarter. That certainly will give us an indication of a very strong economy with downside risk. So should we be concerned about the US-China trade conflict? As I've said, well, it's a concern. We're not a major exporter, but the way I see it, much of that has already been priced in, considering that exports and global manufacturing activity has settled lower, and hopefully all the agreements moving forward would provide a little bit of spark to the trade side. And finally, excuse me, this is the chart as far as the numbers are concerned, if you want numbers for your planning purposes, GDP, inflation, the policy rate, bond yields moving up, potential for investments, minimum of 5% return, and the way we see the dollar peso behaving, peaking in the third quarter of the year, coupled with the downside risk. The way I see it, and let me summarize by saying that let's not get all this disaster risk, geopolitical risk, distract us from the real argument of whether this economy is bound for a stronger potential of more than 6%. And the way I see it, it's not just the OFW remittances and its impact on consumption or relatively mediocre inflation, better than what we've seen in 2018 or 2019. But it's really seeing the rollout of all these investment catalysts, from the infrastructure to ongoing PPP projects and investment project approvals, of which, as I've said earlier, BOI reported a 1.14 trillion pesos worth of investments, private and public, that hopefully we will see deployed, not just second half of this year, but also provide us with a very strong argument why 6% growth, if not more, is upon us over the medium term. Let me end here, and thank you so much for this opportunity to share with you my 2 cents worth.